And now, it's time to see what was in your inbox last night with Michelle from Payometry Labs.
Hey there, Fintech folks and payments pros. Welcome back to Your Inbox Last Night, the podcast that cuts through the clutter of your email and delivers only the best bits from Fintech and payments news. I'm your host, Michelle from Payometry Labs, and it's March 26, 2025. Every day we dive into nearly 3 hours worth of Fintech headlines and industry updates, so you don't have to. Instead, we serve it all back to you in about 10 minutes, kind of like a personal assistant who reads all your newsletters, skips the jargon, and hands you just the gold nuggets, minus the coffee stains. Before we jump into today's news buffet, here are a few choice appetizers. A Trump-backed stablecoin? That's not a punchline, it's policy. UK shoppers are ghosting their online carts, and it's not them, it's the checkout. And the CFPB would like just a little more time before their next courtroom showdown. Yesterday's episode was fraught with technical challenges. Let's just say that I was feeling all kinds of Mercury retrograding. Anyway, in case you missed it, here is a quick recap from yesterday. The U.S. Treasury dialed back anti-money laundering rules, exempting domestic firms from ownership reporting, essentially gutting one of the most effective anti-corruption laws in recent memory. Treasury Secretary Scott Bessent is on a mission to centralize power, proposing that the Fed hand over its regulatory authority to the Treasury. Oversight, but make it political. State regulators raise their voices about stablecoins, asking, nay, begging for federal action in an environment where regulation is about as fashionable as fax machines. And while some compliance efforts are fading, FinCEN is doubling down near the Mexico border, now requiring Social Security numbers for cash transactions over $200. Bank oversight for sure, but only if you get paid in cash and want to have a bank account. Now, as we always do, let's start with popular industry news sources, starting with some heavy hitters. This week in Fintech spotlighted Marqeta, which continues its transformation into a DIY dreamland for Fintech product teams. Their issuer processor APIs now come with low-code and no-code flair, letting fintechs build card programs faster and more flexibly, basically turning payments infrastructure into a drag-and-drop experience. Over at Payments Dive, Fiserv CEO Frank Bisignano is under fire. Senate Democrats are grilling him over his potential leadership of the Social Security Administration, citing concerns about corporate conflicts and cuts to SSA staffing. It's a clash of fintech meets federal benefits, and let's just say the committee isn't pulling punches. Meanwhile, Bank of America is trying to help businesses treat payments as more than just an afterthought. According to Payments Dive, they're enhancing their digital banking app with better client feedback integration. The goal? Streamlined functionality and increased adoption for business users. Because payments shouldn't be your side hustle. The Paypers brings us a cautionary tale from across the pond. UK consumers are walking away from their shopping carts at alarming rates. The reason? Clunky, frustrating online checkouts. British shoppers apparently have no patience for digital friction, and who can blame them? And Banking Exchange, bless their hearts, is reminding us PCI DSS v4.x compliance is due by March 31st, 2025. If your organization touches card payments, it's go time on updating your systems. Compliance isn't optional, and that deadline is practically peeking through the curtains. Well, it's time for the big story. The headline grabber today, a Trump-branded stablecoin, or is it more than that? Yahoo News, Fortune, Politico, The Wall Street Journal, and others are reporting that the Trump family, via World Liberty Financial, is launching USD1, a stablecoin pegged to U.S. Treasuries and dollar deposits. It comes just as President Trump is doubling down on transforming the national currency within the next few months. Oh, I apologize. Does that sound hyperbolic? Well, let's stick to the facts. With USD1, the Trumps are offering a one-to-one digital dollar with a MAGA twist. What could go wrong? And while you might assume this is just branding, it aligns perfectly with the White House announcement of an executive order to shift all federal disbursements and receipts to digital payments. Oh, did you miss that in your inbox last night? Yes, the White House issued a new executive order. No, not the one all over the news about reducing the voter rolls by 9%. This executive order is entitled Modernizing Payments to and from America's Bank Account. So, what are we doing now? First, no agencies can pay anything by paper check anymore. And you remember, about 3 or 4 weeks ago, they set credit card spending limits on government cards to a $1 limit. Next, the Treasury Department will be mounting a public awareness campaign to educate people on how to use digital payments. And when is all of this going to slowly roll into place? About 90 days. All agencies still operational within the federal government must submit compliance plans to meet these requirements within 90 days. But it doesn't actually go into effect until September 30th, 2025. But not to worry, the so much more efficient federal government is going to allow exceptions. For example, if you don't have access to a digital bank account, well, you're exempt. How we are going to find you and sign you up for this exception is, missing from the executive order. No CBDC here. Trump made that clear. It's about efficiency, fraud prevention, and, well, convenience. Especially convenient if your family is also launching a coin. So what could happen? Well, the fact that the Trumps named this coin USD1 instead of another eponymous tribute to themselves should signal that they expect this to be used widely. It also tells me that they want to be listed above the most stable of stablecoins, USDC. So, are we one executive order away from all other stablecoins being illegal to use? Never say never. You'll remember we reported on the tensions between Secretary of the Treasury Scott Bessent and the Federal Reserve yesterday. Bessent wanted more control over the currency. Well, don't worry, because there's no mention of the Fed in this executive order. The Department of the Treasury is running this show. But wait, there's more. Let's talk numbers. According to Fortune, this isn't just a moonshot meme token with a red hat on it. USD1 is reportedly backed by U.S. Treasuries, cash, and cash equivalents, with BitGo, a seasoned crypto custodian, managing reserves. No complex yield farming, no interest payments, and definitely no anonymous founders with anime avatars. Just a Trump-backed family business offering you a digitized George Washington, wrapped in Ethereum and Binance Smart Chain. And in case you were wondering how serious this is, $550 million has already flooded into the Trump crypto ecosystem, thanks in part to early investors like, checks notes, Justin Sun, who's casually fending off SEC lawsuits while dropping $75 million into BOLFI, the project's governance token. Ethics experts? Let's just say they started hyperventilating into brown paper bags 2 weeks ago when a deal was clear between Trump and CZ. Now they're just passed out. Meanwhile, over at CNBC, they're trying to keep it together by calling this the latest entrant into the stablecoin wars. Because, of course, nothing says sound monetary policy like a Trump-branded DeFi war chest, casually entering a market currently ruled by Tether and Circle. And speaking of DeFi, World Liberty Financial is pitching itself as a full-service crypto bank, aiming to supercharge decentralized lending, trading, and whatever else people are willing to YOLO their digital dollars into. According to Politico, the Trump sons, yes, Donald Jr. and Eric, are officially at the helm as Web3 ambassadors, flanked by longtime loyalists and a couple DeFi developers with a history that includes a $2 million hack. Don't worry, that's just crypto hazing at this point. But here's the plot twist. While most people are still figuring out how to unfreeze their Venmo accounts, this whole thing lines up beautifully with the administration's new policy framework. As you read earlier, the executive order on modernizing payments makes it crystal clear. No paper checks, no stamps, no excuses. Everything goes digital. And who just so happens to be launching a private sector stablecoin right as the U.S. government phases out analog payments? Oh, right. The same family that currently occupies the White House. Total coincidence. But don't worry, there's definitely no central bank digital currency in the works. The operative word there being central bank, of course. Trump has said no himself, multiple times. This isn't Big Brother issuing programmable dollars. No, this is more of a family-friendly, MAGA-certified dollar alternative with strong vibes and no pesky oversight from the Fed, which, by the way, is entirely absent from the executive order. Almost like someone forgot to loop them in. Instead, the Department of the Treasury is steering the ship, with Secretary Scott Bessent now overseeing digital transformation and monetary infrastructure. Bessent is possibly the only guy in D.C. who could push through a crypto agenda while side-eyeing the Fed into irrelevance. So, is USD1 the future of money? Let's recap. It's backed by treasuries. It's named to outrank USDC, issued by a private firm run by the president's family, dropped in sync with a government-mandated digital payments shift immune to Fed oversight. already raking in $500 million in token sales. What could go wrong? Well, we're just 90 days and one Treasury Department awareness campaign away from finding out. Let's take a quick peek into some other crypto and Web3. Besides USD1, it's a quieter day in Web3, but the implications are loud and clear. With stablecoins being promoted at the highest levels of power, while also under scrutiny from regulators, 2025 is shaping up to be the year crypto goes institutional, or at least political. Time for today's regulatory roundup. Payments Dive reports the CFPB has asked for more time to respond to a lawsuit questioning its authority over non-bank financial players. They may have fired everyone, the lights might be turned off for non-payment, and there's a creepy 19-year-old with a pocket protector sleeping under the desk. But if they could just get a teensy bit more time, that sound you hear is eyes rolling all over DC. Banking Dive shared that Federal Reserve Governor Michelle Bowman wants to rethink those gosh darn negative comments on bank application reviews. You remember Michelle Bowman. We spoke about her earlier this week. President Trump is getting ready to make her even more powerful in the charge to roll back banking regulations. Since even one disgruntled voice can derail an entire application process, Bowman's basically saying, why y'all gotta be so mean? Now, what was it again the AP said about the Trump family empire of crypto assets? Was it something about a crypto bank? Huh, that's cool. Cool. Well, that provides the perfect segue because in a happy coincidence, NPR's Planet Money gives us the 101 on how hard it is to start a bank in 2025. The post-2008 regulatory landscape means that launching a financial institution is a marathon through molasses. Slow, sticky, and full of due diligence. You know, on account of the global banking system going into freefall, and the U.S. taxpayers bailed out the big banks, making them even bigger in the process. Well, the question is, how will the new Michelle Bowman, gentle suggestions, low regulatory environment change this process? And finally, also from Banking Dive, the Federal Reserve slapped a cease and desist order on Franco-Wing bank shares. The Tennessee-based bank is facing a to-do list of operational fixes to meet compliance standards. It's not a shutdown, but it is a wake-up call. And that's your Fintech Fast Track for today on your inbox last night. From Trump's crypto empire to regulators waving yellow flags, we're keeping pace with the industry. And yes, that pace is dizzying. But we do it all for you. We know you don't have time to read 11 billion fintech and payments newsletters every day, even though they are fantastic. So, we're doing it for you. Remember, don't just subscribe. Join the community and become an executive member. Okay, well, it's 5 o'clock somewhere. So I am imagining myself on a sandy beach with a cocktail before I start this all over for tomorrow's broadcast. We're here daily, untangling fintech, payments, and everything in between. Thanks for tuning in, and remember, we're taking the fine print and turning it into bold headlines. Catch you tomorrow.